All right, everybody, and welcome back to our YouTube channel. Today, we are going to be talking about capital gain and something that you might not have heard of, a capital loss. And the reason we want to talk about this today is in the current market here in Toronto, we're seeing for one of the first times in a very long time, at least in I think both of our careers, that people that have bought are going to be actually selling for less than the purchase price they bought it for.
If they panic sell.
If they panic sell.
If they sell now, if they sell from February to
Agreed.
any time in the maybe recent future or near future, they definitely could be actually selling at a loss.
Right, if you can hold on right now, hold on.
Yeah.
Hang in there.
Yeah.
But if you can't and you have to sell and you want to sell your investment property, not your principal residence, your investment property that you bought at the peak of the market and now you're looking to sell it for a less price than what you bought it for, there's something called capital loss that I don't think a lot of people are aware of. And we're gonna make this video super simple and super short, mostly because there are hours of endless videos out there explaining this in great detail. But I think one thing that YouTube is lacking is some of this knowledge that's not just in plain English. We're not all seasoned investors. Maybe some of you are looking to get into the investment side of things, and a simple, easily worded video might actually go a lot further than some of these videos that are in great detail. So with that being said, let me Google and how to show you.
Google. I think the simplest way to kind of put this is a capital gain is just that. You buy a property for $500,000, it appreciates to $600,000, it's an investment property, and you sell it, you're going to have to pay your capital gains tax on that.
So let's talk about what that capital gain tax is, because it's actually, so again, we use simple numbers. So you bought a property for $500,000 and now it's up to $600,000. It's been an investment for you the whole time. You put it on MLS, it's been rented out, and you've been claiming the income in that property, as you should be. So this is a legal investment property. So when you go to sell that property that's now appreciated $100,000, you're gonna pay capital gain on that.
That is official income that you've earned from buying and selling an investment.
I think what some people are confused about with capital gain, and it's honestly, it's not very common knowledge, so we were understanding that most people don't know what this is about. But what capital gain is you're gonna pay 50% of your actual increased value, the amount that you've made on the property. So again, simple numbers, buy a property for $500,000, you sell it for $600,000, you're gonna get taxed capital gain on that appreciated $100,000 value, not the entire amount, which I think confuses a lot of people. So you're gonna get taxed 50% of the appreciated value.
Now, on the flip side, with capital loss, if you bought a property at the peak of that market for $500,000, maybe you're in an area that depreciated by 15, 20%, and you go to sell it for $400,000, well, you've now incurred a $100,000 capital loss.
So what this capital loss is, and again, we've consulted with real estate lawyers on this just to make sure that we're accurate here. So now you have a capital loss of $100,000. That $100,000 loss stays with you for ever?
Well,
Yeah, so that capital loss will stay with you until your next purchase and when you go to sell your next property. So again, $500,000, you have a $100,000 capital loss. In the future, you buy a property, and it's an investment property as well. You have renters in there, you're claiming the income on that property, and your property has now appreciated. So you bought the next property in a few years from now at $600,000, and now it's worth $100,000 more, $700,000, and you want to sell that property, but you have in your back pocket already that $100,000 capital loss. So when you go to sell that property, you actually break even because they take into consideration that in the past you have $100,000 of capital loss. Does that make sense? I think that makes sense.
Yeah.
I know that I just dropped a whole bunch of numbers on you, and I'm not the biggest numbers person in the world, but basically,
yes.
Capital gain, you're only paying capital gain on the appreciated value. So if it appreciates $100,000, you're only paying capital gain on that $100,000. And if you have a capital loss and you're forced to sell, then that $100,000 loss stays with you until your next purchase. And when you have pay capital gain in the future, you have that in your back pocket that you can take that capital loss and put it towards your next resale.
I think a quick point too to make is that that people don't realize or don't know that this capital gain or capital loss isn't occurred until you sell that property.
Right.
So a lot of people think, oh, the value of my home is going up. Potentially, I'm going to have to pay some sort of tax on that. A lot of the real estate investors or experienced real estate investors will continually let their properties appreciate when they're in a market that's going upwards, and then refinance that money and take it out with a mortgage, right? Because then that money is tax free. It's technically a debt. If I go take $100,000 out by refinancing that mortgage, you're able to access some of that without having to pay those capital gains as well.
Yeah, and that's the thing too. Again, we wanted to keep this video super simple, but there's tons of ways around this. We're just being very straightforward and simple with this and the most plain language as humanly possible to try to keep this from not overwhelming you and confusing you with dropping all these crazy numbers. But there's lots of ways around this and lots of ways to kind of like incorporate this and keep in mind that, again, this is only for an investment property. You're not going to pay capital gain on your principal residence. So this is only for an investment property.
And an experienced real estate investor accountant specifically can help you with navigating this in a more high level way as well. If you're looking to get into 1, 2, 3, 5 investment properties in the future, lots of ways where you can kind of shelter yourself or use that capital loss, capital gain to your advantage.
Yeah, exactly. So anyway, we hope that explains capital gain and capital loss. We hope that none of you experience any capital loss, and you shouldn't. If you can hold on to your properties right now in this current market, please do. The rental market is extremely hot. So if you can get somebody in there paying extra, whatever it may take to hold on to that property, it's very doable. If you need help with the rental side of things, let me know. If you need help with any sort of capital gain, capital loss on the mortgage side of things, Zach is here to help. We try to keep this as simple as possible, and we appreciate you guys watching. If there's any questions or anything you want to talk about as a capital gain, capital loss, please drop a comment in the comment section below. We can gladly have a conversation about this. If you have any points you want to add, let us know. We appreciate you watching, and thanks for subscribing and watching our channel.
Thanks, guys.